Welcome, everybody, and it's good to see many people in person. Sometimes we don't see that, but those of you who are not in person, welcome very much. Today, we're honored to have Andy Levin speak, quantifying the costs and benefits of quantitative easing with Brian Liu, and Bill Nelson is somewhere up there. I don't know. He's going to be able to. There he is on the upper left. Be able to answer some questions, but welcome back, by the way. It's good to see you around the old stomping grounds. So welcome, Andy, and thanks for all you're doing and for all your experience with this. I have to say, this is the most in-depth paper I've seen on this subject that exists. So thanks for doing that. Anyway, get going.
Well, thanks to you and for the hospitality and hosting me as a visiting scholar. I'm here for 10 more days. For those of you who are here in person, it'd be great to get together and chat further. So this is joint work with Bill Nelson, who's chief economist at the Bank Policy Institute, and Brian Liu, who just graduated from his undergraduate studies at Dartmouth and is now just started a new job last week in the private sector. And just keep in mind that the paper and these slides are just our own views. And by the way, one great thing about having Bill Nelson online is if I say anything really stupid, Bill can either instantly correct it or at least during the Q&A. So that's like a safety net for me. So the breaking news, actually, from my perspective, wasn't the press conference today, but news a couple days ago from New Zealand. And I won't read the whole thing to you, but it's fascinating that actually, first of all, the RBNZ conducted large-scale asset purchases. In fact, they used the same name that the Fed had traditionally used. And they conducted those in 2020 and 2021. The difference from the Fed is that they were indemnified by the Treasury Department of New Zealand in the remote, what was viewed as remote scenario where the program might be costly. But actually now, the Treasury Department's already started monthly payments to the RBNZ, and they're estimating as a fraction of the New Zealand's economy that the losses are going to be pretty big. And this is reflecting the rising interest rates and declining net interest income and losses on some of the bond sales that RBNZ is engaging in. So you might kind of wonder, New Zealand's a small country. It's very, very far away. Does this have any relevance for us? And so Bill Nelson and Brian and I have been working on this now for quite a while, trying to delve into the details of what does the Fed hold, when did it buy it, and what are the costs and benefits of what we're calling QE4, which is because there was a QE1 and a QE2 and a QE3 during the last recession, the recovery. So we're calling this QE4. And I should just emphasize that when Bill Nelson and I were at the Fed a little over a decade ago, the Fed was engaged in cost-benefit analysis, and all that's now in the public record in the transcripts and staff materials that were distributed to the committee. I'll just read you one quote here. It was in the FOMC statement when they launched QE3. In determining size, pace, and composition of its asset purchases, the committee will, as always, take appropriate account of the likely efficacy and cost of such purchases. Now, I guess a question which we're really raising here, and I think that there's a lot for the Federal Reserve to do and respond to these kind of questions is, what are the costs and benefits this time around? There might be many reasons why it's different than QE2, QE3, but Bill and Brian and I are going to try to take a stab at a systematic analysis as carefully as we can, looking at the individual transactions, the individual securities, and really getting into the nitty-gritty details. Just to give you a big picture here, the Fed's assets and its liabilities have just changed dramatically over the last 15 years. So on the asset side, they were mostly Treasury bills and Treasury notes. There were no agency mortgage-backed securities at all prior to the financial crisis. Now, the Fed's balance sheet is more than 10 times larger than it was in December 2007. And some of that might be rationalized by changing regulations that have created demand for reserves, and the Fed's committed to providing ample reserves. More recently, the Fed has introduced an open-ended reverse repo facility, and there's a lot of demand for that. And so you might say part of the increase in its balance sheet is, being demand driven. But on the liability side, there's become a huge maturity mismatch. Prior to 2008, the Fed had a very simple balance sheet. Its liabilities were essentially paper cash, and a little bit of reverse repos, but essentially paper cash. And it was holding, treasury notes and bills against that paper cash. Now, the Federal Reserve has a lot of longer term, medium and longer term assets of treasuries and mortgage backed securities that are being held against short term interest bearing liabilities of reserves and reverse repos. Now, I first learned about this actually as a graduate student at Stanford, kind of the problems of maturity mismatch that a developing country might face, or some financial issues might face, and now here it is on the central bank's balance sheet. Some people, Marvin Goodfriend called it a carry trade, except there's no, unlike a hedge fund, there's no hedges here. It's naked risk. Okay, so as I mentioned before, we're going to do very detailed analysis, and I'll take you through kind of how the Fed has affected the footprint in the market through QE4. But then what I'll show you is a baseline projection of the balance sheet over coming years, and we'll compare that to a counterfactual in which the Fed didn't do QE4.
Here is somehow treating the Fed as something different from the federal government?
That's a great question. And so the simple answer to that is no. Actually, part of our analysis is to bring those together into what we call the consolidated public sector, or the consolidated federal government sector. And so I'll show you some information about that. It's a very important part of this analysis.
Could I ask the second obvious question? In some sense, these are mark-to-market losses. Who cares?
No. Actually, it's a great question, but I think that, and by the way, Bill Nelson's been working on these issues for years. You'll go back and read his blast emails or commentaries and published papers. He's been warning about this for years. Okay, and the simplest analysis you can do is look at the duration of the Fed's portfolio and then look at what the risk would be to the mark-to-market valuations from a change in the level of interest rates. And Bill has been warning about that for a long time. But what we're doing here is we're actually looking at the trajectory of the Fed's net interest income, because the Fed has said many times, well, that if they don't sell any of their securities, then there's not going to be any realized losses. And so they would say, well, that mark-to-market stuff's just on paper. Who cares? Okay, what we're trying to look at here is there can be, and likely will be, a real cost to taxpayers if the Federal Reserve's remittances to the U.S. Treasury are much lower than they would be in the counterparts.
So there's Bob's question. Well, the government as a whole went short, and then interest rates went up. Tough luck. But then,
okay, so again, can we?
Question, does this matter?
Okay, I will.
That can have a negative.
Why don't we loop back to that in a few minutes, because I can't cover everything all at once. Okay.
No, but you need to give a deeper justification for concerning yourself with this. If you just look at the entity, the federal government as an entity, most of these issues just completely disappear.
Well, I will try to persuade you.
Is what you're saying that the short-term interest-bearing liabilities, the payments of those are going up, and that's somehow not bearable without? It's like in your New Zealand example. There was some, they transferred money presumably because the payments that the central bank was making on short-term liabilities were going up, and that.
Why can't the Fed just print more reserves to pay interest on reserves, and the heck with the asset side? Because I've tracked this down, it can.
Okay, so I think that the Fed's net interest income is going to change.
Okay. It's not going to pay the Treasury as much money, granted.
Okay.
But how is this supposed to? We just burn the Fed's Treasury portfolio? The Fed just adds reserves to pay more interest on reserves and calls it.
Okay, so I think maybe another distinct question people have raised, and we don't really get into it in this paper, is could the Federal Reserve ever become insolvent? Okay, and I think Bill seems very comfortable, maybe even incrementally more comfortable than me. He can tell you what, but I think he seems comfortable that insolvency of the Fed is probably a remote scenario.
I agree.
And maybe that's essentially what you're saying. But that doesn't mean, and again, we should postpone this, okay? And I will show you some evidence, and then you can tell me if I'm wrong, okay? But to try to look at the consolidated public sector.
Does the public sector thing, which I'm totally with you on, but does the Fed need to have assets balancing its liabilities, or can it simply?
No, I think the people have argued that the Federal Reserve might be able to operate on an ongoing basis with negative net worth. And so that's essentially a way of saying, so that most private organizations can't do that. The central bank probably can. And I think this is issues actually Bob Hall and Ricardo Reich have written a paper, more than one, in fact, that discussed some of these issues. Can we just, let's try, I have a lot to show you here, and it'll be a shame if we don't get through at least some of it.
We got motivated because what is generating resistance here is the Fed just does something special with a piece of the federal debt.
Okay, I agree. Okay, and as I told you, well, we'll look at the whole picture. What else can I say besides that? You tell me, well, we need to look at the consolidated government sector, and I say, we'll do that.
Okay, well,
Should we be worried about cash flows or just the balance sheet?
Why don't we hear what the numbers are?
Yeah.
Okay, is that God speaking?
No, it's me, Andy.
Well, granted Bob's question, it's nice to know what question we're asking of the numbers, but we're not going to get far on that. So let's go see the numbers.
Okay, so and there are multiple dimensions of our paper here, some of which might be of more interest to some of you than others. Okay, the first thing I think we go through in the paper is the evolution of the program, and both of us are trying to be objective and fair. Not to say that anyone can be perfectly objective, but our assessment was essentially three adjectives: opaque, improvised, and inertial. And we probably don't have time to go through that part of it, but in the paper, we go through the sequence of communications and so on. It doesn't seem ideal. And so there's got to be lessons learned here for the Federal Reserve itself of how to do a program like this more effectively next time around. Okay, so leave that from up. But that is an important finding of the paper. Another one, which is independent of everything we've been discussing for the last 3 or 4 minutes, is market functioning. Okay, QE4 dramatically increased the Fed's footprint in the markets for treasuries, in the secondary markets for treasuries and agency mortgage-backed securities. The Fed itself in the past has said that footprint could have adverse consequences for liquidity and for market functioning. The Fed hasn't really commented very much this time around about how this program and these actions could affect market functioning.
Yes, they did.
Okay.
May I interrupt?
Please.
The first trillion of your QE4 was designated as, and in your paper
Yeah.
it says so, as
Yes.
market functioning to the positive side, not to the negative side.
Okay.
And I think it might be helpful to separate what you think of as market functioning here, meaning you're not giving access to people that like to trade treasuries, enough treasuries sometimes, because you own, as a central bank, you own so many of them that there's not enough treasuries to go around for market functioning. From the market functioning problems that cropped up in March and April 2020,
Yeah.
which was there were too many treasuries to go around, and the Fed had to soak some up to keep the markets moving.
Right. I think I would very much like to come back to that question. We will come back to it in the talk, but I'm hoping maybe I can get some more of your time in the next 10 days to draw on your expertise on this. And we cite your work and really appreciate that we learned a lot from it and from others who've been writing about these issues. Okay, but so let's just distinguish here. The beginning of QE4, roughly a fourth of the total amount of purchases was during those few weeks where it was viewed as really part of an emergency response. And that part, actually, we haven't broken it down yet. We could, maybe in the next paper, maybe in collaboration with you, that part might have actually been free. Might have been, because in a kind of emergency, people really want to get things off their books. The Fed might actually, be able to buy things at a pretty good price. Okay, but then the 3/4 of the program occurs, after spring of 2020. Okay,
I think it's one of the strongest points in your paper that the Fed never communicated that it was switching from curing market dysfunction to accommodation. And I think that's the key criticism that I would endorse in your paper.
okay, and that's what we're talking about: program design being opaque, inertial, and improvised. Okay, so the Fed has issued principles. The principles were issued earlier this year, but then they issued their balance sheet plans in May of 2022, how they're going to normalize the balance sheet. And I guess one of the key things about our projections here is the Fed will reach a normal size in broad terms, at least given their goal of ample reserves, by late 2024. So it's not going to take all that long with just allowing maturing securities and principal payments to get back to a normal size. But what seems important here on an ongoing basis is the composition is still going to remain far from normal. And so again, we'll take a look at that. I will try to show you that the Fed did affect the interest rate risk of the consolidated federal government. And given that our baseline projection, the Fed's remittances to Treasury are going to be more than $500 billion less than in the counterfactual where they didn't do QE4. And again, it will be nice to do a counterfactual where they do the first trillion, but not the rest. And that's something, again, we should be thinking about and pursue. Okay. But the cost could be bigger than that. In fact, the simple calculations that Bill and Brian and I have done is that if the Federal Reserve actually starts following the Taylor rule along the lines that Monica Biazzesi and others talked about at the Hoover Conference in May, that's going to call for much higher interest rate hikes than the Fed is currently contemplating or the markets are currently expecting in order to bring inflation back down. Then the cost of this program could be more than $1 trillion to the taxpayers. And again, subject to the discussion we'll have in a few minutes about, are we thinking about this correctly?
Yeah, that's still completely true. You shorten the maturity of government debt and interest rates went up. So,
okay, so those are the key findings. We'll go through them piece by piece now. This is the outline of our paper and the outline of my talk, and I'm going to try to be brief. And then we can spend lots of Q&A going into whatever details you guys want to discuss. Okay, so really this program started in March of 2020. The Fed launched a bunch of emergency credit facilities as they've done before, including some new ones this time around. But that's kind of lender of last resort. What was new in some dimensions, at least this time around, was the Federal Reserve undertook a new role as primary dealer of last resort, or actually what we call in the paper, we call it market maker of last resort. I just forgot to change the slides, but market maker of last resort in the Treasury market. And this is something, again, we'd really like to talk with you and others, to try to think hard about this. A question which I would like to come back to in the Q&A is, to what extent could the Federal Reserve have prepared in advance facilities like a term lending facility, lending against collateral, okay, for say 1 or 2 year terms, like the ECB has done at other central banks, that would have alleviated the extent to which it actually needed to purchase all of these Treasury securities, because that would have really limited the interest rate risk. And Darrell talks about this in your Brookings paper to some extent. There were other reforms that might have been able to happen beforehand. In this case, in mid-March, they launched this program, and basically, for all practical purposes, it became an unlimited market maker of last resort. They said in whatever amounts are needed.
could I ask just clarification on how this program worked? So my impression is what the Fed said is we're not legally allowed to buy treasuries direct from the Treasury. So what we're going to do is we're going to lend money to the primary dealers to buy stuff, and then we'll wait a day or two, whatever it takes to be legal, and then we'll buy it back from the primary dealers. Is that basically what happened?
Actually, this slide, the next one, just coincidentally happens to answer your question, at least in part. Okay, because here what we're doing is we're looking at the Fed's total treasuries purchases, and we're breaking it down into the treasuries that issued prior to 2019. We're calling those seasoned, okay, versus the ones that have been issued more recently, okay. And in this emergency in spring of 2020, it was mostly seasoned treasuries. Okay, and the reason for that, which Darrell talks about in his Brookings paper and others have talked about too, is there were a lot of institutions, including some foreign governments, that wanted to get treasuries off of their books and get cash instead. They wanted to basically hold overnight liabilities at the Fed.
Related to be wrong. So the Fed was not financing new issues.
Not at that point. Okay, now as you go forward into the fall and the winter, and this program went on for almost 2 years. Okay, it starts to become more and more true. Right, by 2021, 80% of what they're buying was relatively new issuance that they didn't buy directly from Treasury, but the primary dealers buy at the auction and then sell it to the Fed, weeks or months later. Okay, that's absolutely true. So we'll call it again, break it down here roughly. 1/4 of the purchases are during that emergency period and 3/4 are later. Okay, you're right about the 3/4. Okay.
So this discussion really illustrates the fundamental idea of QE, which is the Treasury and the agencies are borrowing long, which is the wrong thing, and we want to replace that with overnight debt reserves. And it would be much better, of course, if many people have observed, there's no reason that it has to go through the hands of the dealers. It's just the Treasury's made a mistake and the agencies have made a mistake by borrowing long when they should be borrowing short, right? That's it. That's all there is to say about the potential social benefit of QE. It's reversing an error of funding of the debt, federal debt.
A perceived error. Yes,
Okay.
all would be right with the world if only those morons at the Treasury had issued shorter debt in the first place.
All right, and we probably should be distinguishing, I think, at least in principle, and this is a point that Bill and I make in the paper, Bill and Brian and I make, is the Federal Reserve often, when in its communications, especially its FOMC statements, just talks about treasuries and agency MBS as though they're practically identical, but they're not. Okay, the agency MBS is a pipeline where mortgages are issued, and then those mortgages are securitized by Fannie and Freddie, okay, and sold to, and then there's a question here, a real question that's been outstanding now for 15 years of what is the federal government's role supposed to be in all of that?
Bob, you're wrong about these programs because, as Andy just explained, this was a bunch of people trying to sell treasuries, which could be of any maturity, and the Fed didn't like the prices that those people were getting. So the Fed propped up the prices for people who were trying to sell treasuries. And then in the fall, the Treasury was trying to issue at any maturity and not getting the prices it wanted. And the Fed said, don't worry, we'll buy it all. So this is actually quite different from the older QE was, we're going to fix a maturity problem. This QE was very much, we're going to keep the prices up in the secondary markets.
Okay, so let's just shift gears for a moment here to the right side of this chart, okay? So during spring of 2020, the Fed actually didn't buy that much MBS. Like in that first month or 6 weeks, they bought like 150 billion. So compared to the Treasury intervention, it was actually pretty small. There were some stresses on the MBS market for a short period, and there's some really nice New York Fed analysis that goes into the nitty-gritty daily and weekly data during the emergency in March and early April. Okay, but what you can see in this picture here on the right panel is that by the summer and by the fall and by the winter, almost everything the Federal Reserve was buying in the MBS market was newly issued MBS. So in effect, instead of the original model for MBS, which is banks and brokers, lend in the mortgage market to households, those mortgages get securitized and packaged and then sold to institutions in the private sector. What starts happening here by late 2020 and into 2021 is the Federal Reserve, for practical purposes, was buying the entire net flow of MBS.
And I don't see the distinction you're drawing here. I
Okay,
mean, in all of these places, what the Fed is doing is buying MBS in the TBA market, which is the pipeline, as you say, from housing through banks to the mortgage market. The distinction you're drawing here, to me, in your picture is artificial because at the start, anything that they're buying in the TBA market is recently issued because that's what the TBA market functions as. As you go later, what the TBA market is delivering is recent vintages. So of course, it's not going to be.
I know, but and this is just to emphasize the point that there was a period at the very beginning when they were providing emergency actions.
But even in that period, what they're really buying is in the TBA market. So there, I think.
I'm not sure that, I'm not even sure that, I'm not sure that, because usually the TBA market, and we should really move this offline, okay, because we're just at too nitty gritty of a detail here. But usually that would refer to the period after Fannie, say, or even during, because the Fannie is announcing the thing, okay, but during and shortly after the Fannie is issued the security, okay, is this TBA. What the Fed was doing here during spring and summer of 2020 was buying MBS securities that had been issued years before. Okay, now you could look back and you can actually ask, well, how many of those were originally issued as TBA? How many of them were originally issued as, I forget what's the, kind of the custom ones. There's a name for it.
Private label.
Yeah, the private label. No, not private label. That'd be something else. But the ones that, the ones that are not TBA.
Specified pools.
Yeah,
Okay, because the pools have a lower prepayment risk because of certain characteristics of the mortgage borrowers. Again,
Am I wrong in saying they were not buying those?
they were buying securities that had been issued years before, and so these usual distinctions we make between TBA and pools refer to the period around the time that the Fannie or Freddie is issuing the MBS. Okay, so I mean, if you wouldn't mind,
I'd be interested in understanding this.
They're buying on full faith and credit of the federal government. They're fully guaranteed.
no, there's no issue here about default risk. Again, why don't we? Okay, so we're never going to get through all this. We're just barely scratched the surface. Okay, so but we're going to skip over the Fed communications, and we can come back to this question of was the Fed opaque, improvised, and inertial as we described. But what I want you to see here in this picture, before we get into all the nitty gritty stuff, is Treasury yields were already coming down in 2019. That was probably in part because of developments in China and the global economy. And the Fed itself was starting to cut rates. By the time that QE4 started, yields were already very low. The 10-year yield was below 1%. And that was true during most of QE4. So what you should have in mind here in terms of interest rate risk is, roughly speaking, the Federal Reserve is buying securities, whether it's an agency MBS or a treasury, okay, with a coupon attached to it of 0.5% or 0.75% or 1% or 1.25%. And again, sometimes they're buying at premiums, and we have to talk about amortized premiums and discounts. But just think in the simplest case that the Fed is buying a treasury security or an MBS with a fairly long duration with a coupon of 0.5% or 1%. And so the interest rate risk is actually not that complicated, because in a situation like we had over the previous decade, short-term interest rates stayed low. The Fed bought a lot of stuff with low coupons, but its liabilities were also pretty limited in terms of its interest-bearing liabilities. And so everything worked out fine. This time around, the risk they were taking on was, if there's a fast recovery, if the vaccines are developed quickly, if the economy gets back up to speed quickly, the Fed might need to normalize the level of the federal funds rate quickly. That was the asymmetric risk. And I just want to make it clear here, this was not totally unforeseen. Mickey Levy and Mike Border and I have a paper I think we presented it at Hoover 2 years ago in May, scenario analysis, where we talked about the upside scenario where the vaccines were going to be developed quickly and the economy was going to get back on its feet quickly and the Fed would need to raise rates quickly.
Andy?
Please.
I mean, relying on Arvin's work with Annette, I thought that was a feature, not a bug, that the Fed was taking the risk of those securities out of the market so that investors didn't have to bear those risks. And that would lower yields. And then that would, by substitution effect, corporates and consumers could borrow more easily and get the economy going again.
Yeah, and so this is you're right, absolutely right. This is Bill likes to talk about this all the time. It's the flip side of the coin. So one side of the coin is we're taking duration out of the private sector, and the other side of the coin is we're taking on interest rate risk. And so then that's why it's a cost benefit analysis, because if the benefit to the economy of taking off that duration was big and the interest rate risk was fairly limited, then you say, well, this is a great program. Let's do it more.
So this is very helpful to me, at least. So the restatement of the big picture here is that the Fed is engaging in corrections of market behavior from various sources, but doing things that the agencies and the Treasury could have done if they were smarter.
I'm not sure the agencies might have trouble, but for sure the Treasury.
This is just a question of the funding of a given amount of federal debt. The Fed can't change the amount of federal debt. All it can do is
It can change the maturity. That's exactly right. Right. Okay. So,
But it does raise the question of whether it affected the amount of federal debt.
Fed can change the price of federal debt.
yeah, but okay. So, let me try to move ahead here.
Can we talk about this one point which you made, which
Okay.
seems quite important? The way the Fed was thinking about cost benefit in March, April was, I guess, externally it was clear what they were doing. They were thinking about some market function, or as Darrell's pointed out, market function, treasury market. And then they stopped thinking about it later, or how are they thinking about cost benefit?
All right.
I'm curious kind of how you diagnose what they were thinking about, because that in a way is the puzzling thing as we look back on those events and as I read your paper in the summer and the fall compared to what they were doing 10 years prior.
Okay, a wonderful question. I think that we should be proud of the fact that the Federal Reserve on a long-term basis is probably the most transparent central bank in the world. I think we should be proud of that. We're not always proud of everything in the United States, okay, but that's actually something to be proud of, because it really resulted from congressional oversight in the early 90s. That the Federal Reserve, after a 5-year lag, releases the transcripts of all of their FOMC meetings, and they release all the staff materials that were circulated to the committee. Okay, so in 2026 and 2027, we'll all have access to everything they were discussing and all the staff materials that went to them. My suggestion to the Federal Reserve, and I think Bill more or less agrees, is they could do it a lot sooner in this case. This is important. This is potentially large cost to taxpayers, at least in our view, that it would be appropriate for them to provide more information about how they were thinking about this in real time, as opposed to we're trying to make inferences from some pretty brief statements they made. But
this is really important. The original QEs were this kind of a stock of treasury debt. We're going to buy some of it up, and we're going to try to lower interest rates by doing it. Here we are clearly financing the new issues of the US government. This is different from there's this stuff outstanding, we want to fool around with the yield curve. This is, we don't think the federal government can borrow money, or for some reason we want to.
It depends on who you ask. It depends on who you ask, because at some points
exactly what they're selling.
At some points in the minutes and speeches of Fed officials, they would insist, no, we're not. Right, but there actually are quotes in the minutes, they're in our paper, okay, where officials at the table, and this is in the minutes, we don't have the transcript, but we have the minutes, and they said these purchases could be quite helpful in making sure that yields don't go up as the Treasury, does an incredible amount of deficit financing. And that seemed to me, and Bill, I think when we were looking at this, a lot like what the Fed was doing in the late 1940s after World War II, where they were trying to hold down medium and longer term treasury yields to help facilitate the funding of the deficits in the wake of World War II.
During World War II.
Oh, well, I'm just talking about in the mid to late 40s. But then what happened was the Treasury Fed Accord, which said the Treasury is responsible for figuring out how to finance its deficits and what maturity it wants to issue its, debts. Okay, and the Federal Reserve is responsible for price stability. Okay, under its statutory mandate. Okay, that was essentially the Fed Treasury Accord, and so I think you're absolutely right that in the minutes over the last couple of years, these things have gotten fuzzy. And I think that when Chair Powell went to Congress and encouraged them to think big, I think was the phrase he used. Okay, when the Fed chair comes to you and says, think big, some members of Congress might have interpreted that as, oh, well, the Fed's going to help shoulder the bill in the end. So, okay, but why don't we?
That's a discussion about treasuries. What about mortgages? Because that, as you point out, that really ramps up later, and that's not about financing the federal debt. Right?
Yeah. Okay. So, by the way, I'm going to skip over these tables, but in the paper we have tables that show you the breaking it down all the way into, and this is partly inspired by Darrell Duffie's work. March 18th through April 1st, April 2nd to April 9th. The dates there are corresponding to the dates of the H41 releases. I should say here, by the way, that especially with MBS, what you notice here is the net change in the Fed's holdings of MBS is, I don't know if I have a pointer here. I guess we can try it. Okay, there. It's hard to see.
It works.
Okay, there's 1.335. Okay, that's the net change in their holdings. Okay, but their total purchases were more than twice that big, because what was happening during this period in 2020 and 2021 was mortgage rates are historically low. And a lot of homeowners are refining their mortgages. Okay, which means a lot of the Fed's getting a lot of principal payments on the MBS that it bought, prior to QE4 and the ones they bought during the emergency. And they could have actually said, a normal balance sheet for us is one where there's no MBS. And we'd like to get back to that. At some point in 2020 or early 2021, if they had just said, you know what, we're not going to reinvest the proceeds from MBS principal payments into MBS anymore. Starting January 1st, 2021, we're going to reinvest those into treasuries or just let them roll off. Okay, they would have ended up in a totally different place. They had to make a lot of additional purchases to actually expand holdings in MBS because of all these prepayments and refis that were happening at the time. Okay, so let's get into the nitty gritty here. I want to really focus on the market functioning here because I think this is important. It may be as important over time as what we think of as the potential cost to taxpayers, and maybe you'll be more persuaded about some of these issues. As Darrell said, we're trying to distinguish here between the initial emergency versus the ongoing kind of purchases they made during most of QE4. Prior to QE4, the Fed was very straightforward in acknowledging, look at it here, this is a quote from Simon Potter, who at the time in 2013 was the manager of the Fed's open market account. The committee is aware of the potential for large-scale asset purchases to contribute to financial market dysfunction. If the Fed were to become too dominant a buyer or holder, it could reduce the tradable supply, discourage trading, leading to miserable liquidity and price discovery. And that could ultimately raise borrowing costs and undermine the program's policy goal. Okay, so the Fed was completely aware of this, alert to it, and trying to make careful choices during the first, QE programs 10 years ago. What's remarkable here about QE4 is it seems like, at least publicly, the Fed hasn't said much about this issue anymore. So as of now, and this is again related to John's point, the Fed now holds almost 30% of the Treasury notes and bonds outstanding. So this is where we get to these questions about how could the Fed possibly affect the consolidated public sector security structure, right? And the answer is, well, if you're buying a third of the Treasury notes and bonds and you're funding those with overnight liabilities, that's a pretty significant change in the maturity structure.
Andy, it's fair to note that although you're taking out a third, which is a large fraction, the stock of treasuries doubled between the time when Simon Potter was talking about it and now. And so the remaining 70% is actually more than it was then, and probably much more than sufficient
Well, but
to keep markets functioning.
so what's interesting to me here, you look at this share of total outstanding, which is the second column here. I'll use my pointer. Okay, it's this column. Okay, that means the share of total outstanding that was issued by the US Treasury Department that was auctioned, okay? And what fraction of that was held by the Federal Reserve in the SOMA account? And the answer is that prior to the financial crisis in December 2007, it was about 14%. As of February 2020, before the pandemic, it was 15.6%. Okay, so during QE1, QE2, 3, okay, they're buying treasuries. Okay, but that's a period where because of I forgot ARA and other things, the total debt was increasing. Okay, and the Fed's holdings were increasing roughly in parallel. But when you go from February 2020 to March 2022, the percent of the total outstanding doubles, and that's where I think we get very close, much closer to John's concerns. That it really looks like the Fed's not just keeping up with the expansion in debt; it's
But that's going back to the other issue, which is accommodation, fiscal support. Right now, you're talking about market functioning. Are there enough securities in the market to meet the daily needs of exchange back and forth?
okay, and that
The point I made was, let's say that number is 5 trillion, 14% of the 2007 debt left more than 5 trillion. 28% of the 2022 debt leaves way, way more than 5 trillion in the public hands.
okay. So the
But
best, the most. Let me just make a
28%
comment.
is also a huger number. So as far as the dollars the taxpayer is up for when interest rates.
Different
go up.
issue, not market function.
Yes, no,
Okay.
the market functioning issue is bigger, but also the number that the Fed holds is not just 28%, it's 28%.
Yeah, I'm only making the minor point
Yeah.
that this is not impairing market function when you leave only 70%
Absolutely.
of a quadrillion of treasuries.
Okay, and so I can only say here, but we really should take this offline because I have a lot more to learn, and Bill and I have been talking to a lot of people and trying to understand this, but we have a long way to go. And we hope the Federal Reserve will be more open about how it's making these assessments. The most open, transparent assessment we have is the one that was made by the Federal Reserve in consultation with Treasury 20 years ago. And at that time, they established a cap of 15% on holdings of longer-term Treasury securities. Okay, so that they wouldn't hold more than, and think of it relative to, say, shares of stock. Okay, controlling interest is, I think, when you hold more than 12% or something. So there was sort of a similar idea here in the Treasury market that as long as the Federal Reserve wasn't holding more than 15% of any individual QSIP, that it probably wouldn't be having too much effect on market liquidity. And the problem now, especially since QE4, is that the median security that Treasury note and bond that the Fed holds, they hold 25%. And some of the ones they hold up to 50% or 75% of the issuance. Okay, means it's not just a controlling interest, it's almost like the founder of the firm who still owns half of the stock. And that's what we call the footprint, becoming big. Okay, and then the Fed becomes more like a price maker rather than a price setter, rather than a price taker. And so there's a lot of complex issues here. We just think this is important when we're thinking about the cost of QE4. We should be thinking about this, and maybe in the end the answer is, oh, it's all fine. But given the Fed's prior analysis that 15% was a reasonable cutoff, they're way out of alignment with that. Okay, so just briefly, here's the terms of maturity and the duration of these securities. The simple summary here is that the duration's around 7 years, which means that a 1% increase in the level of interest rates would reduce the value of the portfolio mark to market by 7%. As I told you, we're not going to rely on that for our analysis. We're actually going to run simulations of the whole balance sheet and the net interest income. But you should read Bill's work. He's written lots of really insightful stuff about this. Here's the consolidated government sector. And again, without getting into too much detail, I just want you to notice here that the marketable Treasury securities issued by auctioned by the Treasury Department have an average maturity of 6.2 years. Okay, but the Federal Reserve has bought 30% of those. Okay, in fact, 30% of the notes and bonds. Okay, and it's in our consolidated federal government. Okay, the new liabilities held by the public are these overnight bank reserves and reverse repos. Okay, the average maturity of the consolidated federal government is 4 years. So the Federal Reserve has, in effect, so the Treasury was trying to lock in low rates. They, I think, thought in 2020, 2021 that probably interest rates were going to head upward, or at least there was a risk. And their job at the Treasury Department is to try to have a good financing that's going to be, benefit taxpayers. So they were trying to lock in the low rates, the same as the homeowners were doing in the mortgage market.
Like a husband and wife. Or the husband
Yeah.
Wife wants
And by the way, Debbie Lucas is the one who encouraged us initially to really do this carefully. Okay, and her view was, why can't the Fed and the Treasury just figure this out? And I think that is a good question, but probably the answer to that question is you might need statutes to require it. And then this comes back again to some of John's earlier work.
I went to a Treasury thing, was just Treasury, and I said, why is this crazy thing going on? And the Treasury people said, well, we don't know what the Fed does. Our job is just to finance the debt cheaply. And the Fed people said, well, that the interest cost of the taxpayer, that's not our business. We're just here to finance.
Right.
You should use a better number than average maturity. Since you're here making good numbers, average maturity is a terrible number. So
I can do, so if you want to tell me right now, or we can talk later.
Full distribution of.
We have the full distribution. You tell me, just tell me a summary so I can put in a table.
Maturity is maturity of the principal. So if there's one perpetuity in there, the average maturity is infinite. That's not a good number. So, year, duration is fine. What's the half-life of rollover is fine. Just
Yeah, we actually have the duration. I can easily do the half-life of rollover. Maybe if you wouldn't mind, we could exchange some emails over this, because we could also have more than one table in the paper.
Tactiles be moments any day, if you want to describe a distribution.
Yeah, okay.
average maturity is just a terrible, terrible moment, because it weights
But
principles that are way out there so highly.
I have to say I'm less worried than you are. Okay, the Treasury has issued a very small amount of 30 years, and they're not doing very well in that market. Okay, so it's mostly 20 years and less, and most of it actually is 10 years or less. And so to the extent to which there's a skew, there's a substantial fraction of the issuance that's Treasury bills and 2-year notes and so on. But I don't think this is not like Bill Gates affecting the income distribution. The Treasury has not issued a substantial enough number of the really long term.
It's because coupons are.
Okay, but we can.
Anyway.
Yeah. Okay.
Small.
All right. Now let's go to the MBS market, and I just want to skip ahead here to one slide. Okay. When we were doing research for this paper, we come across FINRA, which is a respected institution, and they have a fact sheet for investing in agency mortgage-backed securities. And in the fact sheet says use caution. Of course, the fact sheet's not designed for a big bank. It's designed for personal individual investors. Use caution. Investors who draw comfort from a dependable and consistent semi-annual payment may find the unpredictability of MBS unsettling. And I thought maybe, someone at the Federal Reserve should have this posted on their door. Because the truth is here that the MBS works differently than treasuries. It's much, much more complex. Okay. And there are risks that unless you delve into it, you just wouldn't even imagine. Okay. That's why, by the way, if you know this term of convexity, that treasury securities have positive convexity, MBS have negative convexity, okay, which means the way that a level change in the level of interest rates affects things is totally different direction, qualitatively different for MBS than for treasuries. Okay, so I think I do need to show you this table. Okay, so as of December 2007, the Fed didn't hold any MBS. They had held small amounts 20, 30 years ago because they were doing repos and reverse repos, and they ended up in a few cases acquiring MBS because those were valid as collateral. But really, there was zero on their books as of December 2007. As of now, the Federal Reserve holds more than 40% of the total outstanding amount of agency MBS. So we're not that far from what Bob was describing. Okay, instead of the federal government just acting as a pass-through to securitize, or even having a chartered, a government chartered agency doing the pass-through to securitize things, but all the mortgages are actually held by the private sector. If we do a QE5, this number could get up into 80% or 100%, and then essentially the consolidated federal government will be holding all the mortgages. And do we want that? I think there's questions here for people concerned about markets and free markets and all the rest. Is this a good idea? I think I'm still curious to hear what Darrell thinks about the market footprint, because in this case, for the median security the Fed holds, they hold 74% of it, and for many of them, they hold 90% plus. Okay, so it seems clear that in the MBS market, the Fed has become the price maker, the price setter. They're not the price taker. Okay, and in the paper we document that almost half of the Federal Reserve's purchases of MBS, almost half, was in 125 purchases that were more than $5 billion each. Okay, and some of those I've looked on Bloomberg, those securities were never traded. There's no like recorded trades in the Bloomberg terminal, which means the Federal Reserve, the Summit desk is, I know they're all smart and have high integrity and all the rest, but they're in a discussion with a primary dealer about buying a security that's never been traded. And if they're off by one basis point on a $30 billion purchase, that's non-trivial.
So legally, the Fed can't buy directly from the Treasury. What you're saying is it can buy directly from Fannie and Freddie, something that's never even.
Oh, I don't, actually, you're asking legal questions. I'm not the right person to, maybe Bill knows, but leaving that question aside, we're not necessarily, you're right, because as we get into late 2020 and 2021, maybe the Federal Reserve could have just gone to Fannie and Freddie and said, hey, why don't you guys just give us a call when you're ready to do the auction, and we'll buy 3/4 of it.
Wouldn't have gotten the bid-ask spread on the home.
Well, okay. I mean, so anyway, the footprint is very, very big here.
Andy, you're talking about footprint. I mean, the other issue you could have spoken about is, which they spoke about 10 years ago, is the Fed really did compress mortgage treasury spreads, probably by 75 basis points, which is juicing the housing market in this period, which a decade ago, they were worried about financial stability risks associated with that. And
Yes.
they somehow I didn't hear anything about that. They're buying a large fraction, but they're really pushing up real estate prices.
Was this an effort?
What's the time?
Okay, yeah, we have about 25 minutes left. The good thing is we try to mix the Q&A in with the.
It always happens.
Bill might want to say some things.
Okay, so let me try to wrap up here in 5 more minutes. I think we can do it, and then we'll leave 20 minutes because I know there are also a lot of people dialed in. Okay, so what happened between last fall and this spring was interest rates started rising a lot. As of a year ago, the Fed was expecting, if you look at their dot plot, that they were only going to make a couple rate hikes this year, and that rates were going to take many, many years to get back to normal. And by late last year and early this year, the picture was really changing. The Fed was saying, no, we got to move fast. What I want you to see in this table here is that has very big effects on prepayment rates on mortgage-backed securities. Because what happens is prevailing mortgage rates go up, the rate of refis goes down. And not only that, but people have incentive not to move anymore. I'll tell you personally, that's the situation we're in. We were thinking about moving from Vermont to New Hampshire. Now it's out of the question because we'd have to, go to a new mortgage. It would be 2 or 3 percentage points higher than the one we have. So, so what that means is that the duration of the Fed's holdings of agency MBS has lengthened substantially. And of course, we're not over here. As we talked about, if the Fed actually starts following the Taylor rule, the prevailing level of nominal interest rates could go up further. Then in principle, these durations could increase even further. That's what the negative convexity is all about. Is you have these coupons, these coupon securities that you bought in 2020 and 2021 that effectively pay coupons of 1%. And this is a nightmare. This is why FINRA said, be careful. Because what's happening here is the prevailing level of rates is going up, which means the cost of the Fed's interest-bearing liabilities is going up, but they're stuck with these securities for an even longer period because the principal payment flow is going down. And here's a nice picture we put together just to illustrate how the outstanding balance lengthens and lengthens and lengthens as you move to higher rates and the prepayment rates drop. Another point I want to make here, the last point about this section is some of the Fed's holdings are actually quite liquid, about a quarter of their holdings. And this comes back to this thing about the most liquid ones are the recently issued custom pooled securities. Okay, and the reason they're custom is because those were created to have more predictable prepayments. Okay, and those are pretty liquid even after their auction, for months or years later, they still tend to be more liquid. The TBAs are less liquid, and the seasoned TBAs are even less liquid than that. And so what you're seeing here is when Federal Reserve officials say, oh, well, we might decide to start selling our MBS to have them unwind quicker, especially in a situation where prepayment rates have come down, we should be aware that that's not going to be so easy. And the Federal Reserve cannot and should not engage in a fire sale of its MBS holdings, which means that if MBS are much less liquid than treasuries, it's probably not a good idea for taxpayers for the Federal Reserve to start going out and.
Andy, that was Loretta Mester, one Federal Reserve Bank president who was kind of off the reservation on, nobody else was really talking about selling MBS back to the market.
We don't have to name names here, actually. I wouldn't even have named one name. But what I will say, though, is I talk to reporters all the time. And maybe because one Fed official even said it once, and maybe he doesn't even think that now, it's in the air. And market participants and others, people in Congress are kind of wondering, oh, well, maybe that's the way to solve this problem. And so this chart's important just as a cautionary note. Okay, now let's get to the balance sheet simulation. I'm going to be really quick here because there's a lot of details in the paper. Okay, we're using Bloomberg cash flow projections for the agency MBS. Everything else we can pretty much do ourselves. So that part we rely on the Bloomberg terminal. The holdings of Treasury securities, notes, and bonds will decline by roughly consistent with what the Fed announced in May, $60 billion a month. The Fed said that if it wasn't enough, it wanted to hit the 60 billion per month target, that it would be willing to allow declines in its holdings of treasury bills. That probably won't be necessary, at least to any large degree. But because of this change in the prepayment rates, the holdings of agency MBS is going to be only 20 billion a month, which is way lower than the Fed's target. Another issue I just want to flag here is that before QE4, there was just minimal holdings of liabilities of reverse repos. Now the Federal Reserve has created this standing reverse repo facility to try to help the repo market, and it's big. And it probably won't disappear. So there's a question here, kind of, and the Federal Reserve could help clarify this. What's its plan as the balance sheet normalizes over the next several years? What's the composition of liabilities going to be between bank reserves and reverse repos? How will that be reflected in the rates that the Fed sets for those? And a bunch of other questions that they really haven't addressed yet.
You're also active in the repo market now.
Yes, they've created, that one hasn't done much. Okay, but they created it. So there's now there's now a standing reverse repo facility at the bottom. That's like a floor of the repo market. And there's a standing repo facility at the top. That's supposed to be the ceiling of the market. And right now it's the floor that's, that's big. Okay, so let me just take 3 minutes here now to wrap up. Okay, the composition of assets is not going to be normalized in 2024. It's not even going to be probably normalized before the end of the decade.
This is your simulation?
This is our, okay, sorry, good question. Okay, so
we've been waiting for here.
Yep, exactly. So, okay, here's the total assets. The red is the baseline projection based on the Fed's actual CUSIP level holdings. Okay, and the green is a counterfactual if the Fed had not done QE4. Okay, now that includes the $1 trillion that Darrell has been flagging. Okay, so we might want to do another counterfactual where they do QE4 light or something. Okay, and they do that trillion, but not the rest. Okay, but this green line here is no QE4. They just do term lending and other kinds of market reforms, maybe even in advance, so that they didn't actually have to purchase any Treasury securities and MBS.
They let stuff roll off.
Okay, sorry. In the baseline, we're following the plans they announced in May. And that plan is to allow 60 billion per month in roll off of treasuries. And if I remember right, I think it was 30 billion a month and 35 billion a month in MBS. Okay, and what I was just trying to explain was the 60 billion will materialize. The 35 billion a month in agency MBS will not, because the prepayments aren't big enough. And unless they actually sold MBS, those holdings are not going to shrink fast enough, which is why we get to this picture on the right. I'll use my pointer here. Okay, if they hadn't done QE4 and they had just allowed their mortgage-backed security holdings at as of February 2020 to continue rolling off, which is what they were doing, okay, they'd only have 500 billion in MBS now, and it'd be almost gone in the next 5 years. Okay, so they'd be pretty close to really normal. As it is, they bought a lot. They're going to now roll off very slowly, and so they're going to have very, very big MBS holdings still at the end of this decade.
Brian Sack released Brookings GitHub tool this morning that allows you to project the Treasury by CUSIP and in aggregate and predict it going forward.
Okay, cool. We'll have to look at that.
This is available for free?
Yeah.
Oh.
Okay.
You don't work for D.E. Shaw.
Okay, so here's now we're back to the question about the net cost to taxpayers. So we're looking here at the net interest income, or actually expense in some case, net interest income of the Fed. And the blue is under the baseline. The orange is the no QE4 counterfactual. And a green is if the Soma just only held Treasury bills as its only asset. Okay.
Is this coupons paid to the Fed or change in mark-to-market value, or what's the number?
Okay, so this is literally, we're doing this on a quarter-to-quarter basis. Okay, we compute all the Fed's interest income. Okay, which is it's the coupons on its treasuries and MBS, and it's the amortization of its discounts. Okay, on securities held. Okay, and then we're comparing that to the interest expense, which is the payments on the liabilities, reverse repos, and
you're not marking to market.
No, this is not even marking to market.
Cash flow.
Yep.
This is a cash flow, yes. The only thing I do want to say is that this includes the Fed actually bought a lot of securities at a premium during 2020, especially. Okay, they bought a lot of them at a premium, and that premium means the coupon is 2%, even though yields were only 1%. Okay. But the Fed had to pay a higher price for that, and that premium has to be amortized, and it's treated as an interest expense in the Fed's accounting. Okay, so this is all cash flow, and the point here, if you just, and we can do present discount value, it doesn't make much difference here. The number is big. Okay, this baseline cost is on the order of $550 billion.
It's like crucial.
The we're using the forward rates from the Treasury market. And so for practical purposes, that rate as of the end of June had interest rates rising to 3.1% and then being essentially level.
Things could be a lot worse.
Well, that's why I said earlier that if the Fed,
Got it.
and I think we're on the,
Forward.
oh shoot,
Is this the last slide?
I'll skip over this. I think we talked about a lot of it.
Question on the last slide. So. and
Oh,
this
on
is
which slide?
The 500 billion. So
Okay.
This is a big slide.
this is the loss on QE4.
Yes.
If you go back and say, well, the Fed's going to end up doing this occasionally, and it's been doing it for a long time, since 2007, and you added up all the gains and losses, it'd still be a gain at this point, right?
I've been thinking about doing that exercise. I think it's probably another paper appropriately because this one's already too long and complicated, but we could go back and use because all of its data is pretty much available except for the Bloomberg cash flows.
But they announce, the Fed announces each year, this year we remitted, and I think they said like
Yeah.
years in a row, 100
So
billion.
I think a very simple,
15 years of an upward sloping yield curve and interest rates stuck at zero, and people like me saying, I'm being totally
but look
wrong."
here, but I just want to make a point here, okay, which is look at the green line. The green line is the simplest thing, which is just all the Fed's interest-bearing liabilities are matched by interest-bearing treasury bills, okay? And so there's no maturity mismatch there, okay? And then what we call in the paper, the golden goose, okay, that lays the golden eggs, is the Federal Reserve has a lot of non-interest-bearing liabilities, which is paper cash mostly. And it can invest those into treasury securities, and those golden eggs cover its operation costs, and what's left is remittances to treasury. Okay, and we call those the golden eggs.
But there were
okay.
also remittances.
Well,
associated
but just
with
let me 2 more sentences. The green line tells you in a very simple way what's the value of those golden eggs that's just coming from the Fed's paper cash. And the point is that as of 2020, those golden eggs were about $100 billion a year. So when we say, oh, well, the Fed was paying, 50 or 80 or $100 billion a year in remittances to Treasury, that's mostly a golden egg. It's not because QE 1 and 2 and 3 were so profitable. It's because the Fed has a monopoly on issuing paper currency, and that's in most times. So
let's get the other people on. Sure.
Oh, all right. Can I go to the last slide? I think the last. Okay. What do we think are the implications here? We encourage the Fed to think about disclosing more information about its decisions and so on, and the prices that it paid. We think Congress could direct the GAO to review QE4 the same way as Congress directed the GAO to review the Fed's emergency actions during the financial crisis. Congress could authorize the GAO to conduct regular reviews of the Fed. It's just important if they do that to make sure they protect the Fed's independence in setting the stance on monetary policy. The Fed could constrain the Fed's discretion in taking on interest rate risk, which would be analogous to what was done in Dodd-Frank for credit risk. And in that scenario, the US Treasury could be responsible for all the adjustments to the maturity composition, which I think is getting close to what John's been saying for the last hour and a half. And we think that doing this carefully could actually help the Fed, because the Fed really wants to maintain its independence and being able to set the stance of monetary policy over time. And if the Fed does things that end up having huge costs to taxpayers, that could actually end up undermining the Fed's independence. So I'll stop there. Thank you, Bob. We still have 10 minutes, I guess.
Let's see, the other people maybe have questions. Bill, do you want to say something?
Let me also extend my thanks to Hoover for inviting us to present this paper and to actually putting Andy up. I'm sorry I can't join you guys. And I should also give my thanks to Brian and Andy, who've done, almost all of the work for this paper. And I just got to participate in some fun conversations every now and then. And then there's a question that arose at the very beginning. I'll just add a little bit of information on, as Andy noted, I'm not that concerned about the Fed's solvency. I think if you mark the Fed's books to market, you'd be marking currency to zero. And so their capital is really on the order of, $2.5 trillion or something like that. However, there is a limit. There is a limit on the relationship between the Fed's assets and liabilities, and that is that the Fed is required by law to have assets backing its currency, and that can matter if it has a huge hole in its balance sheet in the form of losses, if Congress wants them to value their book at market, which makes sense since it's a collateralization requirement, and if the Fed were forced or chose to become much smaller and got rid of its a lot of its reserve balances in an overnight RRP facility. Under those circumstances, they could actually run afoul of the currency collateralization requirement and be unable to control monetary policy. But that's perhaps a topic for another day. Other than that, it's a lively discussion, a lot of material covered already. So happy to jump back in if other things come up.
So there's quite, if Mike Boskin, Jeff Lacker have a question.
Yeah, I just wanted to get Andy's take on some things he got to at the very end and episodically were mentioned, which is basically the political economy of what's going on with the deficit and debt and the Fed's balance sheet, whether we're really expanding by making it easier for the Treasury to issue, for politicians to think things are free because interest rates are artificially kept low for a while, et cetera, and what benefits and costs that has. I mean, it wouldn't take much of a percentage of GDP for that to swamp the taxpayer costs, or even, you'd have to have a large effect actually to get a revenue reflow that offsets some of that. But in any event, it seems that's part of the discussion that wasn't really fully developed. We had some disagreements, I think, among us and in what was actually happening, whether it was a fixed stock of debt and we were correcting perceived imperfections in what the market was doing or the Treasury was doing or the agencies were doing. And so I think that's important, both in the short run, any effect on the economy. In the long run, with a larger debt, if that's indeed what happened, there'll be cost to fiscal consolidation and so on. And then also the moral hazard of, by the time we get to QE sub N, it's just going to get easier and easier. There'll be more pressure under times which are not as quite as catastrophic as the financial crisis and the COVID, at least temporarily the COVID situation, to be using these tools in a way that becomes unnecessary beyond, let's call it the Duffie minimum.
Andy, you want to answer?
Well, I think that, by the way, John Taylor was my advisor in graduate school, and a lot of, if I have any wisdom at all, it's almost all due to him. I mean, is the benefits of being transparent and systematic and rules-based. And I think that's really what we're talking about here. And ideally, the Federal Reserve would take that on itself to do. I think I was very disappointed in 2019 and 2020 that the Federal Reserve talked a lot about average inflation targeting and almost nothing about any of this, because they could have used that framework renewal to try to develop a more clear, and also on the emergency kind of, contingency planning. Well, what would we do in X, Y, and Z? What could we do to be more prepared? That didn't happen. So the same as we think that the Federal Reserve should be more systematic and transparent and accountable on the setting of the stance on monetary policy, that should also apply to all of these balance sheet things and the emergency operations and other things. And I think that would help limit the political interference and the fiscal pressure.
I had just one quick question: was how your estimates compared to Jim Hamilton's at all? They did a few years ago.
Oh, yeah, Jim. I think I share a lot of Jim Hamilton's views. He wrote a paper in 2018, we cited, that was looking back at QE3 and was somewhat skeptical about the benefits. And I think it did talk a little bit about the potential costs. I'm not aware of whether he has started looking at QE4, but if he does, I'll be eager to read what he says. Sorry?
He was on different questions.
So Jeff Lacker.
Yeah, two things, one small, one large. The small one is that this statement that the solvency of the Fed doesn't matter deserves a little footnote in that conceivably the Fed could have to sell assets in order to drain monetary liabilities of itself from the economy in order to stem inflation. While it's a remote possibility, if their assets are worth less than their liabilities, They could run out of assets to sell and failed to do that. Remote, arithmetically possibility, but worth mentioning. Second, the larger point is, I had a chance to discuss this paper last month and enjoyed thinking about it. The logical direction that this paper is heading is basically to point out the magnitude of the distributional impact on the consolidated Fed Treasury balance sheet and cash flows of the carry trade that the Fed engages in. Now, that carry trade is entirely independent of monetary policy in the sense that you can hold the monetary liabilities of the Fed constant and have it either do or not do a carry trade, just like you can hold the liabilities of the Fed constant, monetary liabilities of the Fed constant, and have it either invest in MBS or not invest in MBS. So the logical implication of their critique is really a bills-only Fed, like the policy that the Fed ran in the 50s, where it just invests in very short-term treasuries. Now, you might argue that there's an irrelevance proposition running around in there, but that has to do with that gets us into legal restrictions that are relevant to the difference between reserve balances and treasuries, and probably a subject for another day. But I just wanted to point that out. Thank you.
Can we hear from David Papel? David?
Okay, I want to push back on the notion that somehow the Taylor rule, or if the Fed's forced, which by the way, I think you really mean the Taylor principle, to raise interest rates high enough in order to bring inflation down, will raise these costs tremendously. And that would be true in a context of a non-inertial Taylor rule where you're talking about 8-10%. I gave here like a month or a month and a half or so ago. Non-inertial Taylor rules make no sense whatsoever for Fed since about mid-2021. If you look at now, I have a new version of the paper that includes the June 2022 SEP projections. The difference between the FOMC projections for end of 2022 and say typical policy rule prescriptions is about 50 basis points within inertial rules. So I just don't see, it's just not that much. I just don't see that argument, how that argument works.
So Bob, let's hear from Bob and then Mickey, and then call it.
At the very beginning of the presentation, Andy, you talked some about the early interventions by the Fed that essentially were kind of emergency market making and have been the subject of analysis by Darrell, Duffie, and other people. Now, it would strike me that the big puzzle here is why we didn't have those take place for 3 months, 6 months, 9 months, and then have the Fed completely move out of the interventions. And to my mind, that those interventions are ones one can argue about, but they're distinct from things that influence the scale of the balance sheet in the way that the subsequent actions did.
So Mickey, and then Andy can respond. Mickey?
Okay, so QE1 involved purchases of MBS, and a week later, in early December 2008, Bernanke said, this is not QE, this is credit policy, and we will unwind this position on a timely basis. And then the rationale for QE2 and QE3 evolved toward we are specifically engaging in QE3 in order to reduce unemployment. There's a direct parallel between that and what happened this last time around, as Darrell Duffie did a spectacular job in describing how dysfunctional the Treasury market was in March of 2020, and how the primary dealers were so dysfunctional. So the Fed had a rationale for intervening and buying treasuries. They've never explained their rationale for buying MBS because that market was just fine. And then their rationale evolved very quickly toward
maximizing inclusive employment and continuing those purchases. So I see this very disturbing trend toward the evolving rationale that rationalizes an emergency policy during during a true emergency, and continuing the program and having unconventional policies becoming part of our convention without thinking about, as Andy's articulated, the real costs of this. And it's going to happen.
Well, then I'll just reiterate what Mickey just said, which is, I think there's a big question looming there, which is there was probably a week or two in March of 2020 where the Federal Reserve was trying to help the MBS market by purchasing securities. But after that, and certainly by May or June, they could have just stepped back and said, we think ongoing purchases are needed in the Treasury market to make sure that market continues to work effectively. And they could have been consulting with Darrell to get his advice about it. But they bought a lot of MBS, a total of $3 trillion worth almost. Okay, in a period when the housing market was booming and the MBS market seemed like it was functioning well. And I think that's going to be a big part of the cost of QE4. And that's, I think, one of the big questions. There should probably be a congressional hearing to talk through and have Federal Reserve officials come and explain some of this, because it's important. Again, thanks to John for inviting us to give this paper, and thanks to all of you for really great comments and questions. And we'll turn it offline now. Thank you.
Okay, thank you.